Chapter 8, Current Liabilities. LO82, Account for Notes Payable and Interest Expense. In Chapter 5, we saw how companies account for notes receivable. Here, we talk about the other side, notes payable. We're going to discuss how notes payable is a liability that creates an interest expense that needs to be paid. Notes payable are a note signed by a firm promising to repay an amount borrowed plus interest. We've discussed this before. This isn't anything really new, so this should be pretty easy stuff for you guys. Interest on notes are calculated as follows. Interest equals principal times rate times time. The face value, the amount borrowed, times the annual interest rate times the fraction of the year. Remember, we're talking about current liabilities in this chapter. So we're talking about notes that are going to be due within less than a year. It might be a 6-month note. It might be a 3-month note. So we've got to calculate the interest on less than a year. So when we're doing this, we're going to leave the annual interest rate as a whole amount. If the annual interest rate is 8%, we're leaving it at 8%. We're taking a fraction of the year. If it's a 3-month note, it'll be 3 out of 12. If it's a 6-month note, it'll be 6 out of 12. So we're taking the fraction of the year, but leaving the interest rate as the whole amount that's stated. So assume Southwest Airlines borrows $100,000 from Bank of America on September 1st, signing a 6% 6-month note. First thing we want to do is record the amount borrowed. We don't care about the interest. Nothing has happened except that we have borrowed the money. So we have borrowed the money. Name one account that we can pull out. What's the first account we can pull out? Cash. Cash, is it increasing or decreasing? It's increasing. Cash is an asset. It's increasing. So we want to debit cash for $100,000. We have our debit, so we know we need a credit. What are we going to credit? Notes payable. We owe Bank of America $100,000. Payable. We have to pay that back at another date. We know this transaction. We've seen this before. We're just simply recording the note payable that we have borrowed. Now, recording interest payable and repayment of notes payable. Now, up here we see the calculation of interest for the full term of the note. $100,000 times 6% times 6 out of 12. It's a 6-month note, so 6 out of 12. Over the entire 6 months of the loan, we're going to owe $3,000 in interest expense. Now, we borrowed this money in September. We don't have to pay it back for 6 months. However, end of the year comes in December. What do we have to do? We have to do an accrual entry to adjust for the interest that would be paid, but we haven't yet paid yet. So we can match our interest expense to the proper period. So how many months have passed from September 1st to December 31st? September, October, November, December. 4 months have passed. We count September because it's the entire month. So we count 4 months have passed. So interest expense is $100,000 times 6% times 4 out of 12. $2,000 of that interest expense goes into the adjusting journal entry. What's our credit? It's not cash because we're not paying it. Interest payable. We're recording the interest incurred but not yet paid. We're going to pay that next year, but we've got to record it this year to match our expense to the proper period. Now, next year comes around, March 1st comes, it's time to repay the note plus the interest. So we have to repay everything back. So when it's time to repay everything back, we have to pay back the note at face value. So we want to debit the notes payable for $100,000. That gets the note payable off our books. It's down to 0. The note is gone. Next, we want to record the rest of the interest expense for the year. the January and February, the other 2 months worth of interest expense that we have not yet recorded. Remember, we recorded 4 months in the previous year, so we've got to record the other 2 months here. 100,000 times 6% times 2 out of 12, we record 1,000. This 1,000 plus the 2,000 from the previous year equals the 3,000 that we're recording as our interest expense. So that's our 1,000 interest expense. What else do we need to record? We need to get our interest payable off the books. We're going to pay that 2,000 now. So that 2,000 credit balance we had from the previous year, we need to debit that to get it off the books in its entirety. By debiting interest payable for 2,000, we're getting this interest payable down to 0. So we've paid off the note. We have recorded our additional interest expense. We have gotten rid of our payable. So we record cash for the payment of $103,000. The face value of the note plus the entire interest expense that we're going to be paying back. Now, there are a couple of other ways that you can borrow money. One is called a line of credit. A line of credit is an informal agreement between a company and a bank. Bank goes in, says, hey, I would like an agreement with you to be able to borrow money whenever I want to. So they fill out the paperwork and they go, okay. Southwest goes to Bank of America and says, I don't need it now, but in the future, I might need up to $100,000 worth of money available. Can I have that available when I need it? And Bank of America runs their checks and says, okay, that's fine. You have this line of credit. So they have this agreement out there that Southwest can go to Bank of America and borrow up to $100,000 at any point in time, but they haven't borrowed it yet. At the time when it's first negotiated, no journal entry is recorded because no money has been borrowed. They've just gone into the bank, filled out the paperwork, and done an agreement to allow them to borrow at a later date of time. Other than that, the journal entries are similar. When they actually go to borrow the money, you would record it the same way. You would record the interest the same way, and you would record the payment the same way. The difference is that you need to understand that when the actual line of credit is negotiated, there is no transaction. Nothing has actually occurred. No money has changed hands. Another way to borrow money is called commercial paper. It's when one company borrows from another company rather than from the bank. It's called commercial paper. The recording of commercial paper is exactly the same as recording from notes payable. Commercial paper is sold with maturities normally ranging from 30 to 270 days. Since the company is borrowing directly from another company, the interest rate on commercial paper is usually lower than on a bank loan. Because of this, commercial paper has become an increasingly popular way for large companies to raise funds. So just understand the definition of commercial paper and line of credit, and how to record those is the same as a note payable. Just know how to record them. Lastly, accounts payable. You know what accounts payable are. Accounts payable are amounts owed to suppliers of merchandise or services. They can also be called trade accounts payable because they are accounts payable that have arisen from actual trade that you're in, your trade or business. They're accounts payable that you incur doing business. Most accounts payable are current liabilities. However, they could be long-term liabilities depending on the due date. So just always watch that to see when they're due, to see if they're going to be current or long-term liabilities.